$170 billion. That's the high end of analyst estimates for the Reliance Jio IPO valuation, which is being prepared for filing with India's securities regulator this month. To put that in perspective, that valuation would make Jio one of the top 3 most valuable listed companies in all of India, eclipsing most of the legacy industrial giants. And Jio is just the headline name in what's becoming the largest startup IPO wave in Indian history.
And here's the data point that captures the scale. Over 48 Indian startups are expected to enter the public markets in the next 18 months. Together, they're targeting more than 50,000 crore rupees in IPO fundraising. That's roughly $6 billion from startups alone, on top of mega listings like Reliance Jio that could individually exceed that entire amount. We're watching India's tech and digital economy transition from private capital to public ownership at a pace nobody has seen before.
Welcome back to Asia Tech Macro. I'm Maya, and today we're diving into what could be the defining capital market story for Asia in 2026, the Indian unicorn IPO wave. We're talking about Flipkart, PhonePe, Zepto, Oyo, InMobi, Zetwork, and dozens of other companies that have been promising public listings for years, finally hitting the markets. And right at the center of it all, Reliance Jio, which alone could be the largest private sector IPO in Indian history.
Let me start with the Jio numbers because they're staggering. Mukesh Ambani officially announced at the 48th Reliance Industries AGM in August 2025 that Jio platforms would file for an IPO in the first half of 2026. The DRHP, the draft red herring prospectus, is being finalized for SEBI filing this month. Investment bankers are floating valuation ranges between $100 and $170 billion.
And this isn't just a telecom company, right? Jio Platforms is much broader than that.
Exactly. Jio Platforms includes Reliance Jio Infocom, which is the actual telecom business with over 500 million subscribers, but also home broadband, digital apps, Jio Cinema, Jio Mart, and a whole stack of digital services. It's essentially India's answer to a hyperscaler, combining telecom infrastructure with consumer internet services in a way that no Western company really replicates.
And there's a fascinating regulatory wrinkle here. India recently changed listing rules specifically to make this IPO possible.
Right, and this is critical. The Ministry of Finance revised listing norms so that companies valued above 5 trillion rupees, which is roughly $60 billion, can meet their public float requirements by offering just 2.5% of shares instead of the standard 10 to 25%. That allows Reliance Industries to list Jio publicly while retaining about 97% ownership. This is essentially a regulatory accommodation designed for Jio specifically, though it applies broadly to megacap listings.
That's a huge concession to Reliance. Why would the regulator do that?
The pragmatic answer is that they want India to have global-scale listed tech champions, and forcing Reliance to dilute 25% of Jio would mean either crushing the stock with massive supply or making the deal economically unattractive for the company. So they relaxed the rules to enable the listing. It's industrial policy through securities regulation.
Okay, let's talk about the other big names. Flipkart is the next biggest after Jio.
Flipkart is valued at over $30 billion and will become India's largest ever startup IPO when it lists, both in valuation and likely issue size. They received clearance from the National Company Law Tribunal to re-domicile from Singapore to India, which was a critical regulatory step. They're expected to launch their public offer in 2026.
Flipkart was acquired by Walmart back in 2018 for $16 billion. So this IPO is essentially Walmart unlocking value from that acquisition.
That's the key dynamic. Walmart owns about 81% of Flipkart. They've been gradually preparing the company for a public listing for years, including spinning off PhonePe as a separate entity in 2022. The redomiciliation from Singapore to India was the final piece that needed to be in place. By moving the headquarters to India, Flipkart can list on the BSE and NSE rather than facing the much harder challenge of cross-border listing requirements.
And the timing is interesting because Flipkart's main rival, Amazon, has been struggling in India. Reuters reported that Amazon's India business growth has slowed dramatically due to regulatory restrictions on foreign e-commerce companies and aggressive competition from Reliance Retail and the quick commerce startups.
Right, so Flipkart goes public at a moment when its competitive position is actually stronger than it's been in years. The IPO timing isn't accidental. It's calculated to capture maximum valuation while market conditions favor them. The IPO will allow them to monetize part of that stake and create a public market reference price for the asset. It's also a vindication of the original 2018 deal, which was widely criticized at the time as overpaying.
Let's go through the other major IPO candidates because each one tells a different story about Indian tech.
Sure. PhonePe is the digital payments giant.
They filed an updated DRHP with SEBI in January 2026 for an IPO that would be entirely an offer for sale, meaning existing investors selling their stakes rather than the company raising new capital. The targeted IPO size was around 12,000 crore rupees, roughly $1.4 billion. But here's the interesting twist. PhonePe paused its IPO plans in March 2026 due to geopolitical tensions in West Asia and equity market volatility. The new target window is at least June 2026.
So even with everything ready to go, the macro environment can derail these listings.
Exactly. And PhonePe's pause is a useful reminder. The Indian IPO market is hot, but it's not bulletproof. When global volatility spikes, even highly anticipated listings get delayed.
Then there's Zepto, the quick commerce company we covered in our episode on India's quick commerce revolution.
Zepto secured shareholder approval in December 2025 to raise up to 11,000 crore rupees through its IPO. Their target listing window is July to September 2026. But Zepto has a complicated story. They actually paused IPO plans in June 2025 for a year, specifically to cut cash burn and improve profitability. The Indian quick commerce sector has been notorious for high losses, with Zepto reportedly losing around 35% of revenue in fiscal 2025.
So the pause was about getting their financials in order before facing public market scrutiny.
Right. And this is where the 2026 IPO wave is genuinely different from the 2021 wave. Back in 2021, Indian startups went public on growth narratives with massive losses. Paytm, Nykaa, Zomato, PolicyBazaar, all listed at premium valuations and then collapsed when investors realized the path to profitability was much longer than promised. That's why the current cohort, Zepto, Oyo, and others, are deliberately waiting until they can show profitability or at least a clear path to it.
Let's talk about the broader market dynamics. Why is this happening now? And why are so many companies clustering their IPOs in 2026?
3 reasons. First, the macro environment in India is supportive. India's economy is growing at around 7%. The rupee has been relatively stable. Foreign direct investment hit a record $80.6 billion. Domestic mutual fund inflows are at all-time highs. The conditions for absorbing large equity issuances are about as good as they've been.
And second?
Second, private market funding has tightened globally. Indian startups can't keep raising venture rounds at ever higher valuations. They need exit liquidity for early investors and employees. After years of paper gains, the only way to convert to actual cash is through public listings or acquisitions, and there aren't enough acquirers for the number of unicorns India has produced.
How many unicorns does India have at this point?
India has over 110 unicorns according to Traxon, with many of them now 5 to 10 years old. That's a lot of accumulated private market value that needs to find liquidity events. The IPO wave is essentially the cumulative result of a decade of venture investment finally meeting the public markets.
And the third reason?
Third, Indian retail investor demand is unprecedented. According to recent SEBI data, India has over 150 million demat accounts now. That's nearly 4 times the number from 2019. Domestic retail investors are absorbing IPOs at scale, often oversubscribing issues by 10 to 20 times. This is the structural shift that makes large IPOs viable in a way they weren't a decade ago.
The other interesting dimension is the regulatory shift. SEBI has been streamlining IPO processes. They introduced confidential filing routes, which PhonePe used, and they've sped up the review timeline.
Right. And this matters because the macro tailwinds combined with regulatory accommodations have created what bankers are calling a perfect window for IPO issuance. SEBI's confidential filing process allows companies to begin the IPO process without making their financials public until they're closer to actually listing. This is similar to the Jobs Act provisions in the United States. It gives companies more flexibility on timing and reduces the risk of strategic information being exposed to competitors during a long approval process.
The other thing worth mentioning is the role of domestic mutual funds. Indian fund houses like SBI, HDFC, ICICI Prudential have been raising massive amounts in equity funds. Their assets under management hit a record 67 trillion rupees in early 2026. That's about $800 billion of domestic capital available to absorb new issuances.
And that's the structural shift that makes mega IPOs viable. 10 years ago, an Indian IPO of even $1 billion would have struggled to find demand. Now you have domestic capital pools that can absorb $5 to $10 billion listings without breaking a sweat. The combination of retail investors and institutional mutual funds has created an entirely new equity market depth.
That's a transformational shift. India is no longer dependent on foreign portfolio flows to support its primary market.
Exactly. Foreign investors still matter, but Indian listings can now succeed even when foreign flows are weak. That's what allowed the 2024 IPOs to perform reasonably well despite global volatility.
All right, contrarian corner. The consensus view is that this IPO wave is a massive validation of India's startup ecosystem and a once-in-a-generation buying opportunity for investors. Alex, what's the skeptical read?
My contrarian thesis is that this IPO wave might be the top of the cycle, not the beginning, and the parallels to 2021 are stronger than people want to admit.
Go for it.
First, let's revisit what happened in 2021. Paytm listed at a valuation of about $20 billion. The stock collapsed within weeks of listing and is still trading well below its IPO price years later. Zomato had a similar trajectory, though it's recovered somewhat. Nykaa and PolicyBazaar both saw massive post-IPO sell-offs. Investors who bought at IPO lost significant money. The 2021 wave was a textbook case of overvaluation meeting public market reality.
But the 2026 cohort is supposed to be different. They've improved profitability, they have more conservative valuations, they've waited longer to list.
That's the narrative, and there's truth to it. But look at the actual numbers. Zepto is still losing roughly 35% of revenue. PhonePe's profitability is improving, but the margin profile of digital payments in India is structurally thin because UPI charges almost nothing. Oyo has been promising profitability for years, and the financial trajectory has been bumpy. Even Flipkart, with Walmart's backing, isn't a profit machine.
So the fundamental economics of Indian digital businesses haven't changed as much as the narrative suggests?
Exactly. The Indian consumer internet market has structural challenges that don't disappear just because companies decide to go public. Average order values are low. Customer acquisition costs are high relative to lifetime value. Competition is brutal because Indian consumers are price sensitive and switch easily.
Okay, but devil's advocate. India's digital infrastructure has matured dramatically. UPI processes 14 billion transactions per month now. The Aadhaar identity system has 1.3 billion enrollments. ONDC is creating a new e-commerce architecture. These are genuinely transformative platforms.
Those are real and important. But the platforms themselves don't necessarily translate to profitable businesses for the companies operating on top of them. UPI is a public utility. The companies built on UPI, like PhonePe and Google Pay, can move money, but they struggle to monetize transactions. It's the classic platform value capture problem. The infrastructure creates massive economic value, but most of it accrues to consumers and merchants, not to the platform companies.
That's a powerful point. The Indian digital economy is creating enormous social value, but the listed companies might not be the best way to capture that value as an investor.
And here's the deeper concern. The Reliance Jio IPO is a separate animal from the unicorn wave. Jio is profitable, has a real moat in telecom infrastructure, and is tied to Reliance Industries' broader cash flows. But the unicorn IPOs are essentially asking public investors to absorb the unrealized losses of venture capital funds. The early VCs have already made paper gains. The IPOs let them exit. But who's left holding the bag?
Public market investors who bought in at IPO prices.
Right. And there's a reason why mature markets like the US have seen IPO sentiment cool. The 2021 SPAC and tech IPO bubble created a massive overhang of underperforming listings. Investors are now much more skeptical of growth stories without proving profitability. India might be 18 months behind that learning curve.
The other concern is concentration risk. If 48 startups all list within 18 months, that's a massive amount of supply hitting the market simultaneously. Even if individual companies are well priced, the aggregate pressure could weigh on valuations.
That's exactly right. The Indian primary market hasn't absorbed this much equity supply in such a short time frame before. The retail enthusiasm is real, but it's not infinite. At some point, the marginal buyer disappears, and the IPOs that come later in the wave face much tougher pricing dynamics.
So your contrarian view isn't necessarily that the IPO wave fails, but that the timing matters enormously, and the late-stage participants might face very different outcomes from the early ones.
Precisely. The first few IPOs in a wave often perform well because demand is concentrated. The last few often underperform because supply has overwhelmed demand. We're at the early stage of the wave right now. By late 2026 or early 2027, the dynamic could look very different.
Action items time. What should investors and business professionals do with all of this?
3 concrete actions. First, separate the Jio IPO from the unicorn IPO discussion. They're different asset classes that happen to be hitting the market at the same time. Reliance Jio is a profitable, infrastructure-heavy telecom and digital services company with predictable cash flows. The unicorn IPOs are growth-stage tech companies with much more variable economics. Don't lump them together in your analysis or your portfolio thinking.
And what should you actually look at for Jio?
For Jio, the key metrics are subscriber ARPU growth, free cash flow generation, and the trajectory of broadband and digital services revenue. Jio's mobile business is mature, so growth has to come from broadband, enterprise, and digital. If those segments are scaling profitably, the valuation can support $100 to $170 billion. If they're not, even the lower end of that range might be aggressive.
Got it. Second action?
Second, for the unicorn IPOs, focus on profitability metrics, not growth rates. The 2021 cohort taught us that revenue growth without profitability doesn't translate to public market success. Look at the unit economics. What's the contribution margin per order, per customer, per transaction? What's the path to operating profitability, and how confident is the company about the timeline? If a unicorn is still losing more than 20% of revenue with no clear inflection point, the IPO is essentially asking you to fund their losses indefinitely.
And the prospectus is the right place to find that information.
The DRHP is the most important document. Read it carefully. Look at the cohort retention data, the customer acquisition costs, the working capital requirements. The Indian retail investor frenzy can drive prices up regardless of fundamentals, but eventually fundamentals reassert themselves. The question is just whether you want to be the early buyer or the late buyer in that cycle.
What's the third action?
Third, watch the secondary market performance of the early IPOs as a leading indicator for the rest of the wave. If the first wave of listings, say PhonePe in June, Oyo in mid-year, perform well in the first 3 months post-listing, that's a positive signal for the rest of the cohort. If they tank within weeks of listing, that's a signal that public market appetite is more limited than the primary market enthusiasm suggests.
So the early IPOs are essentially canaries in the coal mine for the broader wave.
Exactly. And there's a historical pattern here. In 2021, the first few Indian tech IPOs performed reasonably well at listing, then deteriorated as more supply came to market. By the end of the wave, even high-quality companies were struggling to get fair valuations because investors had been burned. We could see the same dynamic in 2026.
Let me add one more dimension: the secondary effects on the broader Indian economy. If $50 to $60 billion of IPO proceeds enter the Indian financial system, even partially, it changes the liquidity dynamics. You'll see VCs who exit their positions deploy capital into new investments, which could create a new wave of startup formation. You'll see retail investors who profit on the early IPOs feel wealthier and consume more.
Great point. There's a wealth effect dynamic that's underappreciated. The IPO wave isn't just a financial transaction, it's a redistribution of paper wealth into actual liquid wealth that flows through the broader economy. The macro effects could be meaningful, especially if Indian consumer spending gets a boost from successful listings.
And if you want all the IPO data, valuation benchmarks, and analysis we discussed today, we publish a free daily newsletter at asiatechmacro.substack.com. Every IPO we mention has detailed coverage there.
Coming up next, we're looking at DeepSeek V4, the trillion-parameter Chinese AI model that just launched, running entirely on Huawei Ascend 950PR chips. Alibaba, Tencent, and ByteDance have collectively ordered hundreds of thousands of units. This could be the moment China genuinely breaks free from NVIDIA and CUDA dependence.
That's going to be a huge one, especially because Alibaba, Tencent, and ByteDance are all reportedly placing massive Ascend orders to run V4 in their cloud services.
And the geopolitical implications are enormous. If China can run frontier AI on Chinese chips, the entire U.S. export control strategy for semiconductors needs to be rethought. We'll dig into all of that.
That's going to be a huge one.
Stay data-driven. Bye.